Hey, everybody. Hope you're doing well. Hope everybody's enjoying the warm weather. Welcome to June. Cubs finally put some runs on the board last night, and they're still terrible. Let's be honest, Cubs. There's room for improvement, but that's not why we're here. Wanted to give you a little background, a little update as far as the market goes, as far as what to expect for interest rates, what to expect for home prices. Obviously, this is a recurring subject, but it's fluid. So just wanted to give you the latest news. So we had Fed meeting last week. Jerome Powell came out and made an announcement that the Fed had met and they raised interest rates by 3/4 of a point. And that's the Fed funds rate that they increased to 1.75%, up from 1%, which is the biggest jump since 1994. Certainly a sign that Jerome Powell and the Fed is very serious about trying to get inflation under control, and they're certainly willing to act in extreme ways. So I wanted to give you the chart below so you could compare the Fed funds rate historically with the following chart underneath that one, with the average mortgage interest rates over that same period of time, going back to about 1971 through 2022, through I believe it's last month, 2022, or maybe first quarter of 2022. So you can kind of compare the two charts and see traditionally the difference between any increase in the Fed funds rate and increase in mortgage rates is less than half a point. It's about 0.42%. Although this year, in 2022, we saw the Fed funds rate open the year in January at 0.25%. We're currently at 1.75%. So we've increased by about a point and a half. And interest rates have jumped by almost double that. So we're hovering around 6% now. We opened the year around 3%. So obviously this is something's going on. There's other factors at foot here. And I wanted to make sure we were all aware of at least one of those major factors, being the end of quantitative easing and the beginning of quantitative tightening. And those are fancy words, quantitative easing, quantitative, it's hard to say, quantitative tightening. But Google it. Quantitative easing is basically the action of a Federal Reserve Bank or a central state bank purchasing securities to kind of artificially keep interest rates low. So what happened was, and this is third time I believe that the Federal Reserve Bank of the United States has done this. I believe the policy was originated in Japan back in 2001. Anyway, not a history lesson. In a way it is. But this latest round, Fed dropped interest rates back in 2000 at the start of COVID down to 0.25%. And just was really worried about the pandemic, about what it was going to do to the economy. So they wanted to keep interest rates really low. They wanted to keep money fluid for struggling businesses. So what they did was, again, they couldn't lower prime anymore, or the Fed funds rate anymore. So they had to take another step. So this is, again, the third time that we've done this. So they purchased mortgage-backed securities and U.S. Treasury bonds. And what that does is, as the demand increases on these Treasury bonds and mortgage-backed securities, the interest rates or yield that these securities have to offer can be lower. They don't have to make these securities as attractive. So it kind of artificially increases demand. So it increases demand, supply stays the same, interest rates come down. So in theory, that's the way it's supposed to work. And in practice, that's the way it did work. Works really well. However, as 2021 came to an end back in November, we started to hear that they were going to end this latest round of quantitative easing, which is originally scheduled to go through June of 2022, and they're going to cut it off early. So they ended it in March, and it was also March this year, 2022, that we saw the first Fed interest rate hike. And since that hike back in May, so last month, we kind of heard rumblings that they were going to start selling. They were going to start balancing the books or selling these securities that they've been purchasing for the last couple of years. So that's the reverse of quantitative easing. Quantitative easing is purchasing these securities. Quantitative tightening is selling these securities. So they're increasing the supply of these securities. They're selling them, and demand remains constant. So interest rates get pushed upwards. So that has to be a factor you have to pay attention to. In the minutes following last Wednesday's Fed meeting, Powell also said that he predicts the federal funds rate to be somewhere around 3.4% by year end. Again, we're about 1.75 right now, so obviously more increases to come. He also said by the end of 2023, we'd see the Fed funds rate even higher at 3.8%, but take that with a grain of salt. That's 18 months from now, so anything can happen. That's a long-term forecast and certainly subject to change. I also wanted to point out the last graph on here because a lot of you are worried about higher interest rates and crashing the housing market. Wanted to point out the average sales prices going back to 1963 in the United States. And this is again per the Federal Reserve, the St. Louis Federal Reserve site. So you can check that out as well. Seems pretty constant. Obviously, some parts of the graph are kind of level off. Some even dip down slightly. Obviously, 2007, 2008, 2009, average sales price dipped down quite a bit. But that's really the only major hiccup we've ever seen in the last 60 years or so. So for the most part, average sales price of homes continues to increase at a very steady pace. I don't think we're going to maintain the 18% or 16% or whatever we're currently seeing year over year. That has to slow down. That's the whole purpose of raising interest rates, is to slow down appreciation, slow down inflation, and try and get home prices, amongst many other things, gas prices, everything else under control. So last bit I'll leave you with, I just wanted to point out in the late 70s and early 80s was really the only other time we saw interest rates move the way we're moving now. So significant increases in interest rates because, again, we had record inflation back in the late 70s, early 80s. So it was about 40 years ago. You've heard this mentioned, I'm sure, in the news that interest or inflation hasn't been this strong since the early 80s, late 70s. And in the early 80s, late 70s, we saw mortgage interest rates around 17%. The Fed funds rate was actually higher than that, and homes continued to appreciate. And even after they drove up interest rates and started to bring them back down, homes appreciated even more. So check out that graph, check out the website. Appreciate you checking out my video. Please let me know what questions and comments you have. Reach out, shoot me an email, give me a phone call, and I'd be happy to discuss how this information impacts your life, your business, your home, your decisions moving forward. Look forward to hearing from you soon. Have a great day.